Welcome back to the podcast. On today's episode, I have with me Simone Joyce, who's CEO of Paypa. Simone, welcome to the podcast.
Thanks, Kate. It's lovely to be here.
Do you want to start off by telling us a little bit about yourself and your background?
Sure. So as you said, I am the CEO of Paypa. Paypa is a company that my brother and I co-founded all the way back, well, what feels like a long time ago now, but it's not really a long time ago. At the beginning of 2018, we started. At that time, it was my brother and I and a group of amazing engineers who are still with us today. We only had, it was 4 of them back then. Today we have about 40 people in the company. Why did we start Paypa? I had come through an experience with another startup that had been sort of semi-acquired by a payments company. And through that experience, I got to go and work in that payments company. And it really set me up with, I guess, a love. It sounds a bit corny to say, but as much as you can, I just really loved the payments industry. And I found that there was a lot of opportunity in the industry in Australia and more broadly globally. At that time, we're really focused on Australia. And we really wanted to investigate a specific problem in the industry, which we set about doing in 2018.
I don't think it's nerdy at all to say that you're a payments enthusiast. I am exactly the same. I love talking about payments and banking. So you're in good company. Do you want to tell us a little bit more about what Paypa is doing at the moment and in particular the problems you're solving for your customers?
Yeah, sure. I guess building on the previous answer, where we were really wanting to investigate and make a difference was in a scenario where there was an ongoing relationship between a payer and a payee. They have a lot of different names: subscription payments, recurring payments, membership payments, ongoing payments, whatever name you want to give it. It is something that is an ongoing relationship, and typically the payment has been pre-approved, whether for one amount or a variable amount or variable frequencies. The reason we were looking at that is back in 2018, it was a very, even 4 years ago, it was still quite a different landscape than what we're looking at today. There were a lot of legacy systems and a lot of legacy providers in the market. Everything was really heavily running and still is on our legacy system, which is BEX. We might know it as direct debit or direct entry in some cases. And there were third-party providers that had come about in that market, in the early 2000s, whose business models weren't really aligned with success of both the payer or the business. We're seeing a lot of lost cash flow for a business and a lot of customer churn and anxiety and angst on the consumer side. We had a good look at the industry and went, well, we could create a system that's a better mousetrap, a better software system for the business and superficially solve some problems. Or we could do the same on the payer space and create more of a blunt force instrument to, force cancel payments and that sort of thing. But that wouldn't have really solved the underlying problem in the industry, which was that a business and a payer are fundamentally disconnected after that first sign-up happens. And if you think about a paper form, there is no magic portal that shows you when your payments are going to come out and what to do if you need to change your account or so forth. And through the credit card land, where you're seeing a lot of credit cards being put into forms or, heaven forbid, written down on paperwork, and that's the last you see of them until you realise that you've accidentally lost that card and now you've got all these late fees. So we wanted to create a system that really addressed the ecosystem from a platform perspective. So something that connected those two parties together for the benefit of everyone and created a transparent system that had equitable management on both sides. We called that a smart payment agreement. It wasn't digitized, it was digital from day one. And it meant that once you, as a payer, had received this digital payment request from a business, you could onboard and continue to revisit that space to see when your payments are due, what you've paid in the past. You could switch bank accounts and cards. You can change payment days and dates to suit your financial cycles. And even, if you do accidentally have a payment fail, which surprisingly people do. We have many bank accounts in Australia and we forget to move money about sometimes. You can have, a quick self-heal period through a grace period to quickly get that back on track in 24 hours. Obviously, that's super beneficial for the payer, but for the business, it meant more assured cash flow and better relationships with their customers. So we started doing that in 2018, and when we did it, we were sort of wanting to test that it was going to work. It was quite a new thing, and some of the questions we were going directly to businesses in those days. Some of the questions that we were asked were, "Oh, why would I want my payer to see when their payments are due? Won't they remember and then not want to pay them and cancel?" And we realized we couldn't do much about that. That was more of a, well, maybe, you should have a better service that you don't want people to forget about. But over time, we actually not only proved that the hypotheses around this connected environment actually really worked to everyone's benefit. We grew a little bit bigger than what we wanted to. So we were intending to have a test cohort of around the 50 to 80, and we were well over 100 by the time we stopped and went, what do we do next? What we didn't want to do, sorry if I'm talking too long on this answer, let me know when to stop.
No, this is fascinating.
Okay. What we didn't want to do was create another system that competed at the transactional level. We're of the view that was and is a highly commoditized space in Australia, and that wasn't to the benefit of either of those parties for us to be trying to optimize for fees and competing on a transactional level. So we really then thought about the third player in the ecosystem, and that for us was banks or payment providers. So we then started to think about how we could move away from directly serving businesses and move into helping banks to bring these tools to their business customers, knowing that at the time in Australia, we've been through the Royal Commission. We have seen consumer banking experiences starting to update and upgrade to be more competitive at a digital level, but we hadn't quite seen that transition in the business banking environment yet. And that's an environment where there's a lot of space for competitive services and products, and there's a lot of scope for banks to form a closer relationship with their business, whether it's through data, whether it's through dynamic loans, or whether it's through value-added services and products to create a closer relationship. And that's where we really wanted to focus. So we started to evolve. We changed into being a company that is geared to serve banks in Australia, and that's what we're doing today. So 2019, we had our first commercial contract with a bank. That process started, and it was a really key learning process for us. It's very different. You have to look organisationally different and be capable of different things to serve a bank as opposed to serving businesses. And that meant things like accreditations for info security and operational security and all of the things that came with that, as well as obviously a really robust technical system. So today we obviously have banks as our shareholders as well as our clients, and that's really helped us to move forward in our thinking around making sure that we can provide a connected network of smart payment agreements in Australia.
Right. And I think one of the questions that sort of comes to mind for me is, like you said, 2018 probably isn't really that long ago, but over that period, we've seen such massive change in the industry, both in terms of some of the systems that are in place, but even just in terms of how Australians are paying. What, in your opinion, are the most significant changes that we've seen?
So 2018 is a really important year in Australian payments history, which, something that they should teach in schools now. 2018 is the year the new payments platform, or NPP Australia, did their first transaction. So our first real-time instant transaction happened that year in I think it was Australia Day actually that year in January. Back then the NPP was new and there were limited use cases. It was really focused on peer-to-peer. I don't know if anyone remembers the advertising that happened during the Commonwealth Games that year, but it was all about Pay ID, and there was this goldfish person walking around forgetting their BSB and account number. And that was kind of the leader into being able to use the overlay service OSCO to move money between each other. What it didn't really do was address the use case for a consumer paying a business or a business paying another business. That is times to come, and we're getting to that now, which we can talk about in a little bit. But what we did back then is look at that and go, oh, what could this look like? in a world where you can actually create a request to pay over this real-time payments platform, because BEX, as reliable as it has been for many, many years, it does have some fundamental aspects that do not fit with always-on digital economy where we're moving. So that's one, real-time payments. The second thing is obviously CDR, or open banking, as some people might know it. It hasn't made a great impact on payments yet, simply because we're at our early stages. If we think about open banking as through a developmental phase, we've gone through our infancy, and we're probably now in a messy toddler phase, I'd say, where we're not quite there yet as far as full capability, but we're probably understanding a little bit more about how we're operating and what things need to develop further in order to support that industry. And one of those things, I think, will be a specific action initiation, including payment initiation subset. There is information, obviously, in Scott Farrell's Future Direction report that the last treasurer actually adopted 96 out of 100 recommendations on that, hand in hand with adopting 14 out of 15 recommendations on the payment regulation review. And those two things are really going to shape how our payments ecosystem and infrastructure and industry evolves over the next generation.
I think new payments platform is one of those things that people within the industry talk a lot about, and it's actually starting to creep through. I've had conversations with friends and family members about what PayID and what OSCO is, and I'm always somewhat surprised that they know what an OSCO payment is, and very high level, but it's seeping through because of the usability and the benefit it brings to people.
Yeah. And that's how it should be. And eventually, we shouldn't have to make a distinction between a real-time payment and not. All payments should just be real-time. We won't have to name them as such. Yeah.
Absolutely. And I mean, you started to touch on this a little bit, but where are the areas of friction that still exist? And new payments platform has obviously made a really significant change, and we're moving towards sort of CDR potentially as well. But where are those pain points that still exist, those problems that still need to be solved?
Yeah. So I think the way to answer that is to bring us to the next chapter of MPP, where we are now, after the official, I guess, live date of the system called Pay2. So Pay2 is the next evolution of MPP that allows accredited parties to send messages across the top of MPP, to send a message directly to a payer's bank account with a payment request in that message, so that you, Kate, could open your bank account and go, Sarah's Cupcake Shop has sent me a payment request for my monthly cupcake membership. I don't know if it's a thing. I'd probably join it if it was. And you can review that request and accept it within your bank account. And then those payments will be initiated by that accredited party, and it will go directly from your account into the business's account. That is payment initiation. And that's a really critical step forward for Australia. It opens up access to the payment system. That third party might not ever touch those funds, but they were able to provide a payment instruction. And those two banks, your bank and the business's bank, were able to send and then acknowledge receipt of that payment, all within a defined rule set. So that's really important. Where the friction is there, and this is why I'm bringing this up now, is that even though it launched officially on July 1, there hasn't been a single sausage transacted across that network in a live environment yet, because of readiness. So we just don't, the banks to support that weren't quite ready yet. It's actually a really fundamental and big development change that the banks are having to quickly make off the back of having to make changes to support open banking. So, there's a lot of compliance-based product sort of demands on banks at the moment, and this is the next one. However, the good news is that the industry is getting there, and within the next 12 months, so certainly by this time next year, you and I will have an 80 to 90% likelihood that our bank accounts will be ready to receive a Pay2 mandate, so we can agree to pay those cupcake payments. The benefits of that are there's no more providing a BSB and account number on a paper form to someone, and then never seeing those payments again. It's very secure. So if it's not your bank account, those payments won't happen because you haven't accepted it in your bank account. So, I can't sneakily provide Kate's details on my gym form and have you pay those payments for me until you realize what's happening anymore. That's just not a thing. For the business, it means that that's a really secure payment. It means that that payment will happen even if it's a public holiday, even if it's after 5:30, even if it's a weekend. And it means that we can start thinking about the different commercial benefits of not having to provide a credit card-based percentage on top of payments as part of a business's costs. So there's all the packages of the good things. There is friction there, obviously, though. The other point of friction is I describe that as payment initiation, but it's being developed outside of the CDR framework, which means we now have two separate things that potentially will tell us how and when we can interact with payment initiation. So I think that really needs to be resolved at a rules-based level between those two organisations and make a decision about if and when there will be crossover. And then obviously the last piece of friction off the back of that is coming back to our old friend, the BECS system. The industry is waiting right now for the decision on when that will reach end of life, and managing that migration will be complex and long lasting, but important. What we don't want to see is another example of a check-based system hanging around. But with that, you have to make sure that you're bringing people on that journey and not excluding anyone from financial availability because we've taken away BECS and checks.
Yeah, it's such a challenge, I think, getting that balance right of bringing people into something that is better for them, better for businesses, more seamless, and provides all these benefits, but is different because people don't necessarily want to change. And these checks are still around.
Yeah, checks are still around. There's, I think, 36 pieces of legislation that name checks prescriptively as a method of payment. That's I think our regulators these days are very savvy on not writing prescriptive regulations and rules like that. But that scenario I described about you receiving a notification in your bank account, that really relies on you having access to a banking app and having the ability to operate with a banking app. If you are, an Australian, there's many of them that pay their bills at post and have never logged on to internet banking, let alone have an app for it on your phone. That does present some challenges. So I think that really thinking that through before we make any changes dramatically will be really important. In the same breath, I will say I am a massive advocate for removing BECS from our payment systems. I think that it's a necessary step, but also it needs to be taken with caution and care.
Yeah, absolutely. I wanted to pick up on what you mentioned before about CDR, because I think one of the sort of, as you were alluding to, one of the issues or one of the sort of challenges that's facing the industry is you have these two systems, and I think a lot of what we've seen happen in open banking in other markets, open banking here is just quite different, and you do have the NPP, which is already delivering some of those, or starting to deliver some of those really great benefits around payments already. How do you see those two interacting together, and do you think CDR is going to have a really significant impact on payments in Australia, or is NPP sort of the one that's going to be really changing the way Australians pay?
Yes, it's a good question, and I think that one doesn't necessarily preclude the other. And I think it's been really good that Pay2 has developed in isolation away from CDR. CDR, the way that we as a country went about that was actually really complicated and really robust compared to what's happened in other areas around the world. The UK, for example, took a really narrow approach to defining their open banking rule set, and they kept it at open banking. That's it. In Australia, we went, actually, let's create a broad legislation that first of all, assigns data ownership to people as a point of law. That didn't happen in the UK. And for us, that means that our open banking is actually open data. So CDR will extend from banking where it started and go over into utilities and superannuation. And that has already started to happen with those extra sectors being designated. in the States, it happened the completely opposite way. Companies like Plaid and Finicity, to some extent, market-led an open banking infrastructure and kind of went about it a different way without regulation defining how they should do it. So, and that has its own challenges now. So in Australia, that really regulatory broad-based approach meant that we had a slower ramp up, and we're kind of still in that really slow ramp up, and that means that we have to keep stopping and thinking about what we've done. Is it working? What's not working? Consultations and so on and so forth. And that's kind of painful for companies who are wanting to participate fully in a data-based economy. But I'm optimistic that long term will actually create a better set of outcomes for consumers. It doesn't mean that we've got all the decisions right so far. It just means that they've been, there's a framework to think them through. How that will interact in a payment sense, and will payments really be impacted by it? I think not yet. I think that because we kept Pay2 separate and the NPP developed by themselves, it meant it could get to market quickly without waiting for CDR to catch up. So I'm really grateful that that's happened. However, when CDR eventually catches up, we do need to make sure that we haven't got these two separate frameworks running that have separate accreditation. So to go through to become an accredited operator on Pay2, I'd also like to do some CDR stuff. I need to get another accreditation over here. The way I operate over here, for example, this is a bit arcane, so bear with me. There's some fundamental system design decisions that are different. Pay2 has a central repository of mandates that can be referenced, which means that everyone's mandates have a mandate ID in this system, so that keeps it secure. CDR purposely didn't choose to do that. They purposely chose not to have a central repository of consents of sharing under CDR. So there's some really interesting reconciliations that will need to happen at some point. I don't know the right answer about whether Pay2 should become part of the CDR framework, or if CDR should, develop its own initiation framework. I do think that if they did that, it would be very difficult to get banks to line up to support that after spending so much time and investment on the Pay2 system. So pragmatically, that may be something that needs to be considered.
Absolutely. And what benefits do you think that CDR will bring or can bring? Are there other ways that CDR can sort of help to further some of those, some of the challenges, or solve some of the challenges rather in the payments industry? Or do you see sort of CDR as maybe sitting a little bit separately?
I think that's a hard question to answer because I think that Pay2 will solve a lot of the problems that an open banking mandate has been leveraged for in other markets. So coming back to the UK again, and I think it was PSD2, and I'm sure you'll get a lot of angry notes if that's wrong. Part of that was opening up action initiation under open banking, and that actually saw a massive increase in the amount of traffic on the open banking network. Part of that is because you can actually fundamentally see the benefits of a consumer and can continue to see them. And you can also build an economy off the back of that. If the economics of the system aren't there, it's very difficult for companies to sustain themselves long enough to reach velocity of scale and provide those long-term benefits. So I think that having an action initiation piece in your open banking framework is a really good commercial choice. However, I think watching Pay2, the implications of Pay2 for our daily lives will remain to be seen as it spins up. But I think that the actual fundamental changes and some of the use cases that can be spun up out of that, and as companies like ours build out some of the use cases and support banks to do that, that's actually going to be a really hard thing to disrupt if CDR wants to come in with an alternate proposition. I don't think they will. I don't think that that's the idea. And Pay2 is actually being, the rules of that and the customer experience have been designed to respect the CDR rules. So it doesn't look like a different experience as a consumer. And let's be honest, no one's sitting around the dinner table outside our houses anyway, talking about what consent looks like in CDR versus what a consent to a payment looks like. So I think that the thing that we have to keep in mind is the consumer's outcomes have to be at the center of that, whether that's a business or an individual.
Yeah, absolutely. And whatever the mechanism that it is for solving the problem is what's going to be most important, I think, in terms of the end customer. As you said, customers aren't thinking about MPP and CDR, but they do have pain points that need to be solved when it comes to payments.
Yeah. I do think, though, that if you are going to build a payment initiation network as part of your open banking framework, the key ingredient to that is a real-time payment network within the banking infrastructure. So one can't exist without the other, I suppose.
Yeah, I think it's an interesting point, because I think when I look at sort of CDR versus what's happening in other markets, and then you sort of think about the real-time payment element is so key. It's really critical to have that as a baseline, because otherwise a lot of sort of those other nice use cases, they're not in real time.
They're not there. Yeah, that's right. It's kind of like putting a Ferrari engine into a VW. It's kind of going to rattle a bit if you get it on the road. I think the other element that will really solidify our trinity of things is digital ID. So being able to identify yourself, have a CDR enabled experience, present the best pathway for you, and then having that payment actually run in real time in the back. That is a very good thing for many scenarios, thinking about home loans, thinking about insurance, thinking about, I don't know, even purchasing liquor online, for example. They are the digital ID piece, I think, is the last bit that we really need to start focusing in on to have the three things that we need to move forward into the future of finance.
Yeah, digital ID is a good one. I'm going through a banking application at the moment and having to do a wet signature. So having to print a piece of paper, sign it, scan it. I just didn't know that that was still a thing. But
fabulous.
Absolutely
and being able to prove who you are without actually sending, artifacts constantly. Who wants to scan their license and passport and send it places? That's not very secure. But zero knowledge proof is the holy grail, I think, for ID.
Yeah, absolutely. And to what extent are those things even proving your identity anyway? It's just a stopgap. Yeah. When I sort of think about how payments has changed over the last few years, I think it seems clear we're moving towards these sort of more frictionless payments and probably more invisible payments as well, where customers maybe aren't sort of thinking about it or as actively thinking about it as they have in the past. Do you think that does mean more traditional payments providers or banks need to worry about being disintermediated if that process is becoming sort of more passive or more invisible for the customer?
Yes, I do. And I think this is where it comes back to my comment earlier about the transaction being a commodity. It just is. And even, to some extent today, banks find it very difficult to charge for transactions because people just think that's what they should have. It's like turning on the tap and the water comes out. But they are actually a unit that the bank has to purchase from somewhere in order to give to the business to then, be able to use that transaction. But that does mean that there's a lot of downward pressure on transaction pricing. And to your point, I think that it's true. We will have many more experiences in our daily lives where we can walk in and pick up a coffee and walk out without ever having touched a POS terminal or a card. However, there's still going to be acquirers sitting under that transaction that have to perform the payment. The payment won't go away. It's just that the surface layer will go away. And that scenario, let's just play it out a bit further, that wouldn't have happened without an initial on-ramp for the customer. So it's never going to be a scenario. That's actually like one of those nightmare scenarios when PayWave came out. Do you remember everyone was buying those protective wallets because people could just beep your card? I think even jeans had like protective linings on their pockets.
I was just assuming people are walking around with payment terminals.
With RFIs, that's right. With near field readers. But you would have had to, let's just say it's this coffee shop. At some point, you would have had to go, okay, I come here often. This is my frequent one. I'm happy to, let's just say, engage my Bluetooth reader on my phone to know when I'm in range. And I'm happy to have set up a standing mandate in my bank account under Pay2. So every time I walk into your coffee shop, they go, oh, Kate's here. Let's pop, $5.40, assuming you buy a large coffee, $5.40 through to your bank account. The payment will happen instantly and they can see it pop in and out you go. You never touched a thing. I mean, that could happen, and that could happen very, very quickly. But consumers' trust of that, I think, needs to catch up. And you still need to have the appropriate tool for you to go at the end of the day or week or whatever it might be to go, oh, yeah, that's right. I did buy 5 coffees this week, and that's the exact time I did it. Fantastic. So I think that maybe there will be some providers that are disintermediated, and I'm thinking, POS, how relevant is a POS terminal? But there will always be the requirement for providers that create that service layer and that intelligence layer that is there when you need it and at the right times, at the beginning, at the end, and for points throughout that lifetime. And then the other one is the scenario that we spoke about earlier, which is a really good example of gym membership, where the payments are going to come out frequently, but every so often the school fees are coming out on that same day. So you just need to move it to the next day, or you need to be able to have the tools to do that. I was really glad that we haven't touched on buy now, pay later yet, because it's not a payment method. It's just not. It is a service on top of existing payment infrastructure. But what they did do is, let's just take the debate about are they credit or are they not aside, and have a look at the experience that they provided to people. They provided people with a really good interface that allows you to go, oh, okay, I've got these payments coming out on these days. Actually, this card's better for that payment on this day, and I would like to pay this in advance, and so on. That actually put a lot more financial control explicitly back into the hands of consumers. And I think that's the real power of buy now, pay later. That's really cool. And that's part of, even though in 2018 buy now, pay later wasn't really a thing that we knew about, that's the experience that we want to bring to all of those types of payments that aren't based on credit, that are just based on your daily commitments, rent, utility, loans, insurance, gyms, your account with the cupcake shop, your coffee payments that are going to happen automatically. That's all a payment agreement, right? And you should be able to manage it.
Yeah, absolutely. I completely agree. I think it's the relationship changes for customers, but it's changing for the better. It's giving them better payment experiences and more control. And yeah, our data says that as well. Customers like the control that buy now, pay later gives them. I know it's not what the media like to say, but it's definitely what comes through when you talk to customers.
Yeah, and I just think it is a little disappointing that, I mean, it's easy to point out some of the maybe less ideal things about a service or an industry, but it's a really fundamental thing that they did for people who wanted to have that control.
Yeah. So we've spoken a lot about sort of the changes that are happening in the payments space at the moment. I'm curious to know where you think payments are going to go. So if we fast forward, say 5 years from now, are we going to see a radical shift? Are we all going to be not touching anything, taking our coffees and not having the payment experiences? Or do you think is it an evolution? Does it take longer than that to get to that sort of new way of paying?
Yeah, I think that it will be a slow burn. Like, as you said, even now people are starting to cotton onto this thing that is OSCO, for example, and it's been with us for 4 years, and it's been in our bank accounts for 4 years. I think that I don't know if you're probably too young to remember when TVs transitioned from being analog to digital, and it was this wind up, right? And people got reminded all the time, and then all of a sudden you couldn't buy new TVs that weren't digital TVs. The analog ones were gone. And then one day everyone was told, if you don't have a digital TV on this day, you will no longer be able to watch, I don't know, Neighbours at 6 o'clock, which I actually think is finished now, weirdly. And then everyone went, oh, okay, well, there we are. And now we've all got digital TV. I think the same thing will apply to our payments. And I think that it will be an incremental shift and an incremental shift. And then there will be a date where all of a sudden businesses can no longer submit a batch file to do a direct debit payment. There has to be an alternative. Now, banks are going to play a big role in driving that change and providing services that businesses can consume instead. And we will assist banks where we can to do that. But there also will have to be some adaptation made on the end of businesses, from small and micro businesses all the way up to our really large enterprises, that may need system changes. Systems are used to ingesting batch files with very limited data, and now we've got 24/7 real-time data-rich payments coming through at any time. What implications does that have for the business operations themselves? So I think 5 years we'll see that transition happen. And then we won't even, we'll have to, it'll be funny to think about a time when you couldn't make a payment because it was Saturday, you had to wait to Monday to, transfer that money. And we'll all have a little giggle and we'll be in the 24/7 enabled future.
I'm looking forward to it. It sounds great. Thank you so much for your time, Jay. I've had such an interesting conversation. Just to wrap up, can you let us know what Paypa plans are for the next sort of 12, 18 months? What are you working on?
So the next 12 to 18 months will really see us rolling out a lot of the products that we have contracts with banks to roll out. So that's important that we do that. But a big focus for us will be making sure that we can do as much as we can to support the rollout of Pay2 for the industry. And we're really excited to do that. And we'll have incremental announcements coming out over the next few weeks around that. But that's what our focus is. We're really excited about it.
Great. Can't wait to hear more.
Thanks, Kate.
Thanks so much for your time.